Silicon Valley Bank has collapsed. It's the second biggest bank failure in US history. It's the biggest bank run in US history. What happened? Okay, well, let's take a quick trip back to the pandemic. The tech sector was thriving during the pandemic as the world was shut at home. SVB's corporate clients massively increased their deposits at the bank as a result of the boom. Over the space of 2 years, the bank's deposits soared from $60 billion in 2019 to nearly $200 billion at the end of 2021. As banks do, Silicon Valley Bank proceeded to invest that capital. Its investment portfolio therefore soared. SVB's investment portfolio grew nearly fivefold from $29 billion in 2019 to $128 billion in 2021. It took most of that new capital and invested it in long-term bonds. So far, so good. Now, the Federal Reserve has been increasing interest rates since March 2022 to deal with the highest inflation that the US and the world has seen in decades. As a result of those interest rate increases, the US bond market index fell nearly 13% in 2022, its biggest annual loss on record. Similarly, the value of the long-term bonds in Silicon Valley Bank's investment portfolio fell meaningfully too. The bank's deposits started to decline, and that's where the rubber really hit the road. The tighter economic conditions that we've had over the past couple of months have impacted the tech sector. So the tech startups that Silicon Valley Bank serviced were under pressure. It had become harder for these startups to raise capital or generate revenue in the current economic climate. So the amount of cash that Silicon Valley Bank's clients had as deposits at the bank fell. On Wednesday, March 8th, to cover the withdrawals it was facing, the bank sold $21 billion of its investment portfolio. It realized a $1.8 billion loss on this sale. To cover that loss, it also announced on Wednesday that it was planning to raise $2.25 billion from shareholders. That started to cause concern amongst the bank's depositor base about the safety of their deposits. Ultimately, the company wasn't able to raise the capital raise from shareholders that it had announced. On Thursday, things went into freefall. Depositors withdrew $42 billion from the bank, about a quarter of its $173 billion in total deposits. The CEO was reportedly calling clients on Thursday to reassure them that, hey, their money was safe with the bank. But the wheels of fear were already in motion. The share fell 60% on Thursday from $268 to $106. The run on the bank led to the FDIC taking the bank into receivership on Friday. The stock was down another 62% to $42 on Friday when it was halted, and that was that for Silicon Valley Bank. The question now is, what knock-on effects will there be, if any, for the broader market and economy? We've seen several companies come out disclosing how much cash they had on deposit at SVB. Investors seem to be worried about two major fears. The first is that other banks could be facing similar issues to what Silicon Valley Bank faced. For example, look at First Republic Bank. Its share price was down 40% this week. The fair value of the real estate loans it's made is about $20 billion lower than its reported carrying value or book value. That $20 billion shortfall is bigger than the company's total equity. Another company that's been hit has been Charles Schwab. It was down 24% this week for similar fears around unrealized losses in its asset base. The second fear that investors have is around the effect this will have on Silicon Valley Bank's deposits and the knock-on effects on the broader economy. 97% of the bank's deposits are uninsured. Depending on how much of their cash they had at the bank, some of those companies would not have been able to make payroll or continue operating without help. That could have led to job losses, businesses going under, and obviously that would come with knock-on effects. For this very reason, some notable voices have been calling for the government to let Silicon Valley Bank shareholders get wiped out, but protect depositors. Over the weekend, we heard this from Bill Ackman, David Sachs, and Mark Cuban. On Sunday, the Federal Reserve announced that it would be protecting all depositors of Silicon Valley Bank and Signature. The Fed announced that all depositors would have access to their deposits on Monday. The Fed also announced a new lending facility for eligible institutions to ensure that banks have the ability to meet the needs of all their depositors. Basically, the Fed is stepping in and providing additional liquidity to vulnerable banks. Shareholders of Silicon Valley Bank are not getting bailed out, however, as the value of their shares is still being wiped out. First Republic announced on Sunday that it got more funding from JP Morgan and the Fed. And that's the story of the collapse of Silicon Valley Bank. The impact of this failure on the broader economy is yet to be fully understood, but things are moving so quickly. It's a reminder that no bank is too big to fail. As always, thank you for watching.